Hey guys, welcome to Pounds Invested. I'm your host, Stephen Georgiev. Now, before we get into today's video, I really want to thank those of you who have seen my other videos and who have liked them enough to subscribe to my channel. Now, in my last video, I introduced the concept of FIRE, Financial Independence, Retire Early. In that video, I focused on the theory behind FIRE. I talked about how you go about setting yourself a budget, how you go about determining what your withdrawal rate should be, and I also spoke about how you go about determining the total value of your portfolio, taking into account a return rate, an inflation rate, and a 1% buffer. So that was the last video. In part 2 of our series on FIRE, I'm going to talk about how you can put the principles we spoke about in that video into practice. Now, conventional financial advice will tell you to retire or to aim to retire by 68. FIRE, on the other hand, is all about being able to choose when and whether to stop working at all, maybe even decades sooner than conventional retirement planning. Now, for the purposes of this video, we're going to ignore the state pension. One reason and one reason only. Mainly because by the time those of us in our 20s get anything approaching the retirement age, we can't be sure whether or not the state pension is going to exist at that point. And so, for the purposes of this video, we're going to pretend like the state pension does not exist, because for all we know, by the time we get to retirement age, it may not exist. So, how can you fund your retirement if you completely ignore the state pension? Well, we're going to look at 3 structures that you're fully in control of and that you can use to fund your retirement, completely ignoring the state pension. Those are an ISA, a SIPP, and a workplace pension. Now, let's look at the first 2 of those. So, with an ISA, you can contribute up to £20,000 per year tax-free. That means that once you contribute your £20,000 for a particular year, that amount will grow and there'll be no tax on it, ever. The amount that you invest in your ISA will be instant access, so you can access it whenever you like. You can withdraw some, you can put it back, and it will not matter. You will not lose any benefits just by withdrawing money from your ISA. Now, it's important to mention that there's no tax relief on ISAs. Tax relief is going to be something that we'll look at in more detail when we talk about SIPPs and workplace pensions. But for the purposes of talking about ISAs, remember that there is no tax relief, other than, of course, the fact that there is never going to be any tax due on any of that money. Now, let's look at SIPPs. With a SIPP, you can invest up to £40,000 per year. And a little known benefit of SIPPs is you can use carry forward. So that means that if in this year you can't afford to or don't want to pay into your SIPP, that's fine, you don't lose that £40,000 allowance. This applies in total for 3 years. So that means that come year 4, if you suddenly find yourself with a windfall of cash, you can invest up to £160,000 into your SIPP in one go, and you'll get the full tax benefit, just like if you'd invested £40,000 a year for the previous 3 years and you'd invested a fourth £40,000 in the current year. So that's one very useful benefit of a SIPP. You can carry forward your allowance for up to 3 years. Now, in contrast to an ISA, which was instant access, a SIPP cannot be accessed until you reach the age of 58. So it's important to think about whether or not you're going to need the money before you reach 58, before you start thinking about investing in a SIPP. If you're confident you aren't going to need the money before you're 58, then maybe a SIPP is for you. If you're not so sure and you think you might need the money before you turn 58, then maybe an ISA is a better way forwards. Now, let's look at tax relief on SIPPs. Basically speaking, you get tax relief on your contributions into your SIPP, your marginal tax rate. So, as we can see from this table, guys, if you're a basic rate taxpayer and you contribute £80 into your SIPP, the government will top up your contribution by a further £20, bringing your total contribution to £100. If you're an additional rate taxpayer, you only need to contribute £60, and the government will then top up your contribution by a further £40, again bringing up your contribution to £100. The same is true if you're an additional rate taxpayer. In that case, you only need to contribute £55 and the government will top up your contribution by a further £45. Again, this brings the total contribution between you and the government to £100. So, as we can see guys, a SIPP comes with some pretty incredible tax benefits. You get £20, £40 or £45 for free depending on your tax bracket. So the tax relief is designed in this way to encourage you to contribute to your retirement pot. But just as a quick aside, you could argue that offering a higher rate of tax relief to what are probably going to be richer taxpayers who contribute into their retirement pot is slightly unfair. But that's a debate for another day. Now, like we said, contributions to an ISA are instant access and there is no tax payable on the withdrawals. With a SIPP, it's slightly different. Like we said, you can't access your SIPP until you're 58 years old. And when it comes to withdrawals, you have a 25% tax-free lump sum that you can take. The remaining 75% in there is going to be taxable at your marginal tax rate at the time when you're 58 or when you otherwise choose to withdraw it. But let's not forget, any money you earn, however you earn it, whether it's through employment income or whether it's through dividend income or whether it's income you're drawing out of your SIPP, you're going to be able to benefit from the personal allowance, which as it stands today is £12,500. So therefore, for the first 25% of your SIPP that you draw down, there is no tax to pay. And equally, with the first £12,500 of income that you earn in a particular tax year, there is no tax to pay. Let's also remember that the government also allows you a £2,000 per year dividend allowance, on which, again, there is no tax due. Now that we've learned about the tax implications of drawing money out of your SIPP, be sure to smash the like button on this video. Now, we've talked about how ISAs and SIPPs work, but let's compare the two. So, if you were to invest £1,000 into an ISA and £1,000 into a SIPP, what would be the tax implications? Math is a little bit complex, but this table summarises it neatly. So, if you invest £1,000 into a SIPP, there is no tax to pay because your SIPP contributions are pre-tax. So therefore, your after-tax contribution is also £1,000. If your £1,000 contribution were to grow at a cumulative annual growth rate of 8% per year for 10 years, then after 10 years, that pot would be worth £2,159. So when you come to withdraw it, now you pay tax at your marginal income tax rate. Let's assume that's 20%. So once you've paid tax, the amount you're left with is £1,727. Let's work through the same sequence with £1,000 invested into an ISA. So you invest your £1,000 into your ISA. But in order to have invested your £1,000 into your ISA, you'll have paid 20% tax on the income which you've earned in order to invest into your ISA. So you pay your tax at 20% in this example. That brings your after-tax contribution to £800. Once again, if you take your £800 and you grow it at a cumulative annual growth rate of 8% for 10 years, that leaves you with £1,727. And by a complete quirk of maths, do you notice something odd with that number? Well, actually, yes. It's exactly the same as if you invested your £1,000 into a SIPP. So does that mean it doesn't really matter whether or not you invest into a SIPP or an ISA? Well, all other things being equal, it doesn't really matter whether you choose to invest through a SIPP or through an ISA. But let's remember, in finance, things are never equal. This is because in retirement, most people are going to drop down a tax bracket or maybe even 2 tax brackets. So if you're a higher or an additional tax rate payer when you're contributing into your SIPP, you get tax relief at 40 or 45%, as we said. But when it comes to withdrawing the money from your SIPP, because you're likely to have dropped back into the 20% tax bracket, you only pay tax at 20% on your withdrawals. So you've instantly made 20 to 25% just by being a higher or additional rate taxpayer when you paid in and a basic rate taxpayer when you come to withdraw. Now that to me sounds like free money, and free money is exactly what we should be after. But let's not forget that we don't operate in a vacuum. This little loophole is something that a future government is likely to try and meddle with, and when they do, it won't be to your advantage. They are likely to meddle with it, and by doing so, they're likely to make it less favourable to you. So on that basis, it becomes important to contribute to a SIPP as soon as you become a higher or additional rate taxpayer. Now that's one of the benefits of investing through a SIPP. You can benefit from the carry forward rule. So we've looked at SIPPs and we've looked at ISAs. The third vehicle that we're going to look at is a workplace pension. This is a pension you automatically invest into as long as you're an employee. Your employer will match your contribution up to a percentage. So as it stands today, the minimum contribution for an employee is 5% of salary. The minimum that an employer will match is 3% of salary. That means that you get instant 60% return on your investment into your workplace pension. How does that work? Well, if your 5% contribution is equivalent to £100, that means the employer's 3% contribution is going to be equivalent to £60. And so you have just made a 60% return for free on your money through your employer match. As long as you're an employee, it is very much worthwhile taking advantage of the free money that your employer is going to be giving you. So by opting out of your workplace pension plan, you're effectively throwing away 60% of the money which you can earn through that scheme. So just to reiterate, as long as you're an employee, make sure to contribute at the very least the amount that your employer will match into your workplace pension to take advantage of that free money. So now we've looked at ISAs, we've looked at SIPPs, and we've looked at workplace pensions. So what's the order into which you should invest into these three vehicles? Well, if you're a basic rate taxpayer, you can invest through a SIPP or through an ISA. From a tax perspective, it will make no difference when it comes to your withdrawals. But as soon as you become a higher or additional rate taxpayer, it makes a lot more sense, because of the sweet joy of tax relief that the government gives you for free, to start investing into your SIPP first, which is, remember, capped at either 100% of salary or £40,000 per year. Once you've done that, you can start investing into your ISA up to a maximum of £20,000 per year. And let's not forget, all the while, because you're an employee, you'll have been investing automatically through your payslip into your workplace pension. So the order has to be, for additional and higher rate taxpayers, SIPP, then ISA, and at the same time, workplace pension. If you're a basic rate taxpayer, SIPP or ISA, it makes no difference, and at the same time, workplace pension. So guys, I hope you enjoyed this video on how to invest for FIRE purposes. If you did, be sure to smash the like button on this video and also subscribe to my channel for more videos like this. Now that's all I have for you this week. So next week I'm going to deep dive into workplace pensions, because they're actually quite an interesting vehicle to look at in their own right. And so I'll see you in a few days' time.